Good afternoon. Well, we getting ready to close out calendar year 2022, and we'd all agree that we've had a tremendous amount of change and volatility. My goodness, the financial markets, the fiscal policies, monetary policies, geopolitical risk, social risk, just lots of change. And go back 3 years, so maybe it's a good thing we close out and entering into 2023. So we're at an inflection point. That's what we're going to talk about today. And before we get into that, let's just give a recap of where we are year to date. You can see on your screen the U.S. equity market, the S&P 500 is down about 18%. Tech stock, the NASDAQ represents them about 30% lower. International stocks down about 14. Emerging markets down negative 21. You see gold on the right side down a couple percent. You would think that the highest inflation we've had in 40 years, you would think gold would be screaming higher, and yet, go figure, it's flat to down. Real estate investment trusts are negative. And of course, we've had commodities, and the US dollar has been very strong. And the Bitcoin, I threw that in there just because it's been the topic of many. It's crashed. And we'll see what Bitcoin and all that does in the future. So it's been a pretty crazy year. Before we get into the inflection point, let's go back and review just three big themes. And of course, the biggest theme for the last year and a half has been inflation, right? You'll see on the chart, this is coming out of the pandemic here in 2020, and inflation starting to rise 3, 4, 5, 6, 7, 8, 9% increases, peaking in May of 2022. And if you go back to listen to our previous two videos, inflation roll down in May of 22 was our first series. Our second series of inflation was the inflation roll down scenario number 2, where we confirmed inflation is rolling down. And inflation has turned, and it's actually quite interesting. It's falling faster than anyone can imagine, and it will continue to do that. So inflation's a big deal. And of course, why did inflation have its big ride? Look at the supply of money supply. You've heard me say that money supply is the fuel to the economy, much like oxygen is to the fire. And you give a lot of gas to the fire, you're going to have a big fire. And we had massive amounts of increase of money supply. Actually, you see it peaking here in March of 2022. So all through the inflation of 2021, the central bank was pouring more fuel on the fire, just massive amounts. Well, no wonder we had carry forward inflation. And it doesn't make much sense, but that's what's happened. The other big theme, the third theme here, is the Treasury curve. And this is the chart that shows short-term interest rates versus longer-term interest rates. And you'll see the bump there, the little mountain, is 6 months, 1 year Treasury rates. They're about 4.7%. The 2-year about 4.2%, and the 10-year down in here in the 30-year about 3.5%. This is called an inverted yield curve. And what does that mean? It means it forecasts things are going to slow. Well, why does it forecast that? Well, think about it. If you're a bank or financial institution and you borrow short term, you borrow at 5% and loan out money at 3%, you're not going to be around very long, right? So short rates are saying it's going to slow things down. Why? Because the growth of credit and the growth of money slows, because no one in their right mind is going to loan money borrowing at 5 and loaning it out at 3. So it just slows economic activity. It's a forecaster, very, very important. We'll talk about that in a minute. Now comes to the inflection point. This is a great chart, and I'm going to spend most of the time on this. So let's go back to look at the first year, January, February, March. This blue line is the Federal Reserve Fed funds rate, where they've been increasing rates. The Fed funds rate is the rate that commercial banks can borrow from one another overnight. Okay, so that is set by the Federal Reserve. So we had massive inflation starting in 2021, right? You've seen the money supply growth. And yet the Federal Reserve didn't even start raising interest rates until April of this year. As a matter of fact, in March, they were still pouring more gasoline on the fire. Okay, so very slow, way behind the curve. These lines are the interest rates. 2-year is the red, 10-year is yellow, 30-year Treasury. The 10-year is what the U.S. residential mortgage rates are set on. So look, there's a 3% spread between what the bond market was at and the Fed funds. So the Fed was way late in getting to the game. but we've come to an inflection point. Last week, the Federal Reserve had its last meeting of the year, increasing interest rates by another 0.5%. They're now at basically 4.5%. The 2-year Treasury, look here, the orange line. The 2-year Treasury is now at 4.23. It's lower than the blue line. The blue line is higher than the orange line, the 2-year Treasury. And there's been 6 instances that's happened in the past 70 years. So when the Fed funds rate go north or higher than the 2-year Treasury, it signals one thing, that we're very close to the end of the tightening cycle by the Federal Reserve, which means in a short period of time, they'll be done raising rates, done restricting liquidity, and start to reverse the process. You might think, well, if we're going to reverse it in 6 months, why would they just leave it there? Good point. Why don't they just leave it alone? But the fact of the matter is, this is signaling a big change. This is an inflection point. So what does this mean? It means interest rates will continue to go down. You can already see 6 weeks ago, the 2-year Treasury was 4.7%. It's at 4.2. 10-year Treasury, mortgage rates of 6 weeks ago, the 10-year Treasury of 4.25, mortgage rates were 7.5%. Today, mortgage rates are 6.5, on the way to probably 5.5% by the end of 2023. So slowing down, the economy's slowing down. Our prediction, my prediction, by the end of 2023, inflation will probably print negative numbers. In 2024, you won't be talking about inflation. You'll be talking about the lack of inflation. Okay? This is not an inflationary era like the 70s, not even close. I mentioned in our previous videos going through that scenario, so go back and listen and you'll understand why. This is a short-term phenomenon caused by massive amounts of money. At the same time, there was nothing to buy, no services, no goods in 2021, and it was just a total out-of-balance whack, and it caused major disruptions. So the stock market is a forecaster, leading economic indicator. It's been down as much as 25%. It's down 18 today. Probably the next 2023, 2024 will probably be fairly good returns in the market. The next drawdown, if we have one, if the stock market goes down, you're going to be wanting to add risk at this point. That's the first time we said that in 3-4 years, okay? You're going to be adding risk. This is the end of the Fed tightening cycle. They're getting close. They won't say that, but the fact is it's there. And your returns on bonds and stocks, international, U.S., real estate, probably for the next 18 to 24 months are going to be reverse or mirror image of what's happened in 2022. So hang in there. We're getting close to the opportunity. Make sure your allocation is right. Don't be running away from risk, because if it does come down, I'm not saying it's going to, but if it does, that's when you want to add to it, not run away. This is the time to do it, and it's close. So these changes or inflection points are great opportunities for investors. With that, at the end of the year, Merry Christmas, and God bless, and wish you all the best for 2023.